Assalamu alaikum everybody. Welcome back to my channel Rapid Revision. Today's topic is formats of control accounts, and if we start with control accounts, so there are two types of control accounts. One is sales ledger control account and the other one is purchases ledger control account. So what is it about sales ledger control account? So sales ledger control account is a total trade receivables account, and purchases ledger control account is a total trade payables account. So like here in this is a book extract, and this says that control accounts are also known as total accounts. Just like right now I told you, sales ledger control account is total trade receivables account. If the trial balance fails to balance and the error cannot be readily located, it is necessary to check all accounting records. This can take a considerable amount of time. The checking process can be speeded up if the control account for the sales ledger, which contains the accounts of debtors means trade receivables, and the control account for purchase ledger, which contains the accounts of uh, creditors, that is trade payables, have been prepared. These accounts act as a check on individual accounts within these ledgers. So we have a sales ledger in accounting. Also in Edexcel, sales ledger is called trade receivables ledger, but in IGCSE and O levels, sales ledger is which contains the accounts of credit customers. So let's say if I have customer X and I have customer Y and I have customer Z, and let's say the balance brought down for customer X is 100, the balance brought down for customer Y is 200, let's say, and the balance brought down for customer Z is 300. So that means the sales ledger control account will have a balance brought down of 600, because it'll be an addition of 100 plus 200 plus 300, which will give you 600. Then we have what is important is that we need to know that what are the advantages of preparing control accounts. So number one is that it helps locate errors when the trial balance fails to agree, and it helps locate errors in their respective ledgers. So if it is a sales ledger control account, it will help locate errors in the sales ledger. Similarly, if it's a purchase ledger control account, it will help locate errors in the purchases ledger. They are proof of the arithmetical accuracy of the ledgers they control, that is sales ledger and purchases ledger. The balances on these accounts are regarded as being equal to the total of trade receivables and the total of trade payables. So the balance brought down of the sales ledger control account represents the total trade receivables, the amount which our credit customers owe us. So this information is available immediately. Draft financial statements can be prepared quickly because of the balances provided by the control accounts. They help reduce fraud. They help to reduce fraud, as control accounts are prepared by someone who has not been involved in making the entries in those particular ledgers. So sales ledger is maintained by a separate accountant, and sales ledger control account is prepared by a separate accountant. So basically the task is one person is making the sales ledger. So individual accounts of trade receivables are prepared by one accountant, and the other accountant is making the control account. They provide a summary of transactions affecting the trade receivables and trade payables. So you get all the transactions done with the trade receivables in a particular period. So if let's say it's a monthly control account, so you get all the transactions related to your trade receivables in a particular month. And if it's a even for trade payables, same goes for trade payables, because purchase ledger control account is a total trade payables account. What is important here is that the purpose, uses, and benefits of control accounts. So it helps detect errors in their respective ledgers. Also, you get the total of trade payables and trade receivables very easily, and it helps to prevent fraud, because two different accountants, one accountant is preparing the sales ledger and the other accountant is preparing the sales ledger control account. Now, what is important is the format. So what you need to do is that you don't need to rectify the format. Please don't rote learn the format. It's very simple when you try to understand this with double entry. But what I need to tell you guys is that the sales ledger control account is the total trade receivable account. So total of trade receivables. So the balance brought down here represents the total trade receivables at the start of the month, if you're preparing it monthly, right? So total trade receivables at the start of the month. But if you can see on the right hand side, we have a minority balance. So what is minority balance? So sometimes when your trade receivable, my trade receivable is my asset, right? So my customers, which the amounts that my customer owe me are my assets, right? But in some cases my trade receivable will become my payable sort. So in that case I owe my customer. So that is when the customer, let's say, made an overpayment. So the customer was supposed to pay a certain amount, but they made a payment of more than that amount. So in that case I owe my customer. Similarly, my customer might have paid me in advance. So that means I haven't sold the goods yet, but my customer has paid me in advance. So the third reason for a minority balance in the control account would be that if, let's say, I have sold goods to my customer and my customer has given me the payment, so they have actually paid off their account, but now let's say they want to return some goods. So if they return the goods to me after payment, so now I owe my customer. Hence it's a minority balance also in the sales ledger control account, is like a payable. So your customer becomes your payable. And important thing here is that in the sales ledger control account we have only and only credit sales. So sales here is credit sales of inventory. So think of it in this way. Why am I writing debit sales on the debit side? Would be that if, for example, if I'm selling goods to my customers, right? So my trade receivable account will be debited, sales account will be credited. Hence, because this is a total trade receivable account, that is why I'm writing this on the debit side of the control account. Then we have sales returns. So let's say my customers return me goods, right? So when my customers return me goods, what happens is that they owe me less, right? When I'm selling goods to my customers owe me more because they have to pay for those goods that I have sold to them. But when they return goods to me, so that is when double entry will be sales returns account debit, trade receivable account credit. So that means this will basically reduce my asset of trade receivable, because when my customers goods return goods to me, they owe me relatively less as compared to when I just made the credit sales. Also, one more thing, when my customers pay me, so the double entry for receipts from customers, credit customers, would be bank debit, trade receivable credit. So trade receivable is being credited, hence you need to write bank in the details, and you need to write the amount that you have received from your credit customers. Similarly, when I give my customers discount for prompt payment, that is discount allowed. So when my customers are paying me amount within the specified period of time, so that means I will give them a discount. That is an expense in accounting. So for the double entry for that will be discount allowed debit, trade receivable account credit. So I need to write this on the credit side of my total trade receivables account, that is the sales ledger control account. Then if my customers pay me in cash, right? So if my customers pay me in cash, credit customers, the double entry will be cash account debit, trade receivable account credit, because once the customers pay me, um, their their liability towards me reduces and my asset reduces. That is why I need to record this on the credit side of my total trade receivables account. Then let's say if I am writing off an irrecoverable debt. So some customer is not able to pay me and has left the country or has become bankrupt and has faced so many losses that that customer cannot pay me. So the double entry for irrecoverable debt will be irrecoverable debts account debit, trade receivables account credit. So the trade receivables is being credited here, and I will write irrecoverable debts in the details. So irrecoverable debts against this is being debited. Irrecoverable debts is an expense account. Trade receivable is being reduced because obviously there is some customer who's not able to pay me. Uh, Now interest charged on overdue accounts. So some customers, they take very long to pay us. So if let's say there is a customer, that customer has kept my money for a very long time, so I have sold goods to them and they haven't been, like, they are not paying me since a lot of months. So now I will tell them, okay, if they owe me 100 before, I can tell them that, okay, now you owe me 110. So 10% is the interest, $10 is the extra amount that you will pay, because since you are not paying me for a very long time. So interest will basically increase my asset. So now the double entry for this would be trade receivable account debit, interest account credit. Interest in this case would become an income. Similarly, if there is a dishonored check, so there's a two entries for dishonored checks, right? So let's say there's a credit customer of mine, her name is Anna. Anna gives me a check, right? So I will do bank debit, Anna credit. So Anna is my trade receivable, Anna is being credited. But now, when I get to know that the check has been dishonored because Anna does not have sufficient balance in her bank account, so what I'll do is I will reverse this entry. I will do Anna debit and I will do bank credit. So if you look here, dishonored check is coming on the debit side now, because since Anna is being debited, when I received the check, Anna was being credited, so the trade receivable is credited here. And when the check got dishonored, so I had to reverse the entry, and then I did again Anna debit, that is my trade receivable, and bank credit. So this is the entry for dishonored check. So my trade receivable once is being credited. When I have received the check, the trade receivable has been credited, but when the check got dishonored, trade receivable will be debited again. Okay, bank refund. So if my customer has overpaid their account, right, so I will give them a refund. So if I give them a refund, I will credit the bank account. So if I credit the bank account, I need to debit the other account, that is the trade receivable account. Debts recovered. So there's this amount, which is the amount of money that you have received from a previously written off trade receivable. So debts recovered is when previously I have written off someone, but that person comes again and pays me, right? So that's debts recovered. Debts recovered is an income account, but there are two double entries for debts recovered, right? Number one is, if let's say the customer's name was Hamna. Hamna, actually we wrote off Hamna in the past year, but she comes back and she wants to pay us. So I will do Hamna debit the amount, and I will credit the debts recovered account. So if you look here, this is what is happening here. Debts recovered, trade receivable is being debited against debts recovered. So I'm recording this in the on the debit side of the sales ledger control account. And then when she pays me, right? So I will do bank debit. So I will debit the bank account and I will credit the account of Hamna. So it's right here. When I receive the money from Hamna, I will do bank debit, Hamna credit. So this debts recovered is going to come on both sides. When the customer comes back, you make that person your customer again. So I did Hamna debit, debts recovered credit, and when the customer paid me, so I did bank debit, Hamna credit. Okay, then there is something called Contra. What is Contra? Contra is something that goes into both sales ledger control account and purchases ledger control account. But what is Contra? Contra is basically also known as interledger transfers or set-offs. So it's interesting because what happens is that one person is your customer, also your supplier. So you have that person's account in the sales ledger. Also, you have that person's account in the purchases ledger. So if you look here, they've given you an example here. I've taken this from the book. They're saying here, Shweta provided the following information: sold goods 190 on credit to Mansingh stores, Mansingh Road stores. So we have the account of sales ledger account. We have Mansingh Road stores account in the sales ledger, and we've written here 190. And on May 22, they are also buying goods $320 on credit from Mansingh Road stores. It's written on the credit side of the Mansingh Road stores account. Now, the thing is the difference between both. So there is this thing that we have sold them goods of 190 and we have bought from them goods of 320, right? So 190 should be set off against both the accounts, because it's like um, Mansingh Road has to pay me 190 and I have to pay them 320. So rather than they paying me 190 and I paying them 320, we can just set off 190 in both the accounts, and then I can pay them 130 because I owed them more, right? I owed them 320. So that means 190 will be set off in both, right? So we are in the sales ledger in Mansingh Road stores account. Um, I have written purchases ledger here and I have set off the amount of 190, and there is no balance carried down in the sales ledger T account, that is Mansingh Road stores account. And in the Mansingh Road Stores account, that is the supplier account in the purchases ledger. So this is the supplier account. I have written sales ledger here on the debit side 190, and the amount $130 I will pay them through a check. So then I will do Mansingh Road Stores account debit, bank account credit. This 130 I am paying by check. But 190 is common in both, so we are just setting off the amount 190 in both the T accounts. So that means Contra will go in both. It's like a set off, and it will go in both sales ledger control account and purchases ledger control account. Like just like it went into the customer account also, and it went into the supplier account also. So Contra is also called set off. Set off will go in both sales ledger control account and purchases ledger control account. And then the purchases ledger. So we have Contra here, and then balance carried down minority will come here, and the other balance carried down will come here. This represents the total trade receivables at the end of the month, which the total amount that the customers owe us at the end of the month. And then this balance carried down will become your balance brought down, and then minority balance carried down will also become your balance brought down minority for the next month. Then we have the purchases ledger control account. So just like sales ledger control account was a total trade receivables account, purchases ledger control account is the total trade payables account. So that means trade payables is our liability. Liabilities balance brought down come on the credit side. So there is a balance brought down on the credit side. Then we have a balance brought down minority on the debit side. This balance brought down minority represents again the same three reasons for minority. One is overpayment, the other is we have made an overpayment to our supplier. So in that case, our supplier becomes our receivable. The second case would be that we have made a payment in advance, so we haven't gotten the goods yet, but we have made a payment. Also, the third reason could be that we have bought the goods, made the payment, and then we have returned the goods. So that means now my supplier owes me. So it kind of becomes an asset. So in rare cases, it becomes an asset. The liability becomes your asset. Okay. Then when we buy goods on credit from our suppliers, we do purchases account debit, trade payables account credit. So this is recorded on the credit side of the purchases ledger control account. And it's very easy, right? When you're buying goods from your supplier, you owe them more. So that is why your liability is increasing, and liability is increased on the credit side. When we are returning goods to our suppliers, so it's like when you return goods to your supplier, your liability towards them decreases. So the double entry for purchases returns would be trade payables account debit, purchases returns account credit. So this will come on the debit side of the total trade payables account, that is the purchases ledger control account. Then when we pay our suppliers, our bank account is credited, so the trade payables account is debited. When we pay our suppliers in cash, our cash account is being credited, so our trade payables account is being debited. When our suppliers give us a discount, right? So discount received as an income, discount received account will be credited, trade payables account will be debited. And I told you about Contra. Contra goes in both. It goes on the credit side of the sales ledger control account and the debit side of the purchases ledger control account. Then interest, if if we haven't paid our suppliers for a very long time, so let's say it's been a lot of months and we haven't paid our suppliers, so you need to record this interest on the credit side of the purchases ledger control account. And then if we overpaid our account and our suppliers are giving us the money back, they're giving us a refund, or it's a refund against the returns, so you'll do bank debit, so trade payables account will be credited. And then obviously minority balance carried down will come here, because minority balance brought down is on the debit side, minority balance carried down will be on the credit side. There's the majority balance brought down is on the credit side, so the balance carried down will be on the debit side. And then you will total the account, and then you will bring down the balances. So it's like this, you will bring down the balances. And that's it for the format of the control accounts. What you need to know as theory, part of theory also, that trade receivables ledger control account, that is the sales ledger control account, and the trade payables ledger control account, that is the purchases ledger control account. You make these with basically the information, where the information is coming from, it is coming from the books of prime entry. So there are 7 books of prime entry in accounting. One is sales journal, the other is sales returns journal, the third one is purchases journal, the fourth one is purchases returns journal, the fifth one is cash book, the sixth one is petty cash book, and the seventh one is general journal. So I will tell you guys, sales journal total is basically your total credit sales. So sales is coming from the sales journal. Similarly, sales returns journal tells you the total returns by your customers. So this sales returns is coming from the sales returns journal. So I'm writing short forms here. Bank receipts, money coming in the bank from our customers, is coming from the cash book because obviously that's recorded in the cash book. And then discount allowed, we have a discount allowed column in the cash book. Cash receipts, that will also come from the cash book because when our customers pay us in cash, that's recorded on the debit side of the cash book. Okay, bank dishonored check. Dishonored checks are also shown in the cash book. The book of prime entry that shows dishonored checks is the cash book. Bank refund, this is also coming from cash book because we are giving a refund to our customers. Our cash book is being credited. If we pay by check, right? If you give a check refund, you are crediting the cash book bank column. um, this bank debts recovered, so the amount of money that you are receiving from your debts recovered will also come from the cash book. Now, what about interest charged on overdue accounts? So if I charge my customers interest on overdue accounts, my customers are not paying me yet, I'm just telling them that you need to pay more. So this is coming from general journal. So in the sales journal, we have total credit sales of inventory. In the purchases journal, we have total credit purchases of inventory. And in the purchases returns journal, we have the total returns that we have made to our credit suppliers. And in the sales returns journal, we have returns from credit customers, which our customers are giving us. So that means interest, when you are charging interest to your overdue account, it's like you are doing trade receivable account debit, interest account credit. So this should come from general journal. And irrecoverable debts, so the double entry for irrecoverable debts is irrecoverable debts debit, trade receivables credit. So this is also coming from the general journal. Contra is coming from the general journal. Again, there's no money that is being exchanged when there's a contra. Contra is just like set off between the customer's account and the supplier's account. So that is also coming from general journal. This first double entry for your debts recovered comes from the general journal, and the amount that you're receiving from your debts recovered will come from the cash book. And that's it. The next T account, so for purchases ledger control account, the credit purchases will come from the purchases journal. The purchases returns will come from the purchases returns journal. Interest charged on overdue accounts, again general journal. Bank refund, our suppliers are giving us a refund that will be debited in the cash book, so this is coming from cash book. Bank payments to our suppliers is coming from the cash book, whatever payments we have made to our suppliers. Cash payments to our suppliers is also coming from our cash book. Whatever payment we are making to our suppliers in cash will be recorded in the cash book. Discount receipt column is there in the cash book, that is also coming from the cash book. Similarly, the last item here is contra. Contra is coming from the general journal because again in contra no money is being exchanged. One account is set off against the other account, so contra is also coming from the general journal. And that's it for control accounts. I hope this video helps you. Thank you so much for watching.